Hi CA students, let's revise CA Final AFM Chapter 13 Business Valuation Practical Question 3. ABC Co. is considering a new sales strategy that will be valid for next 4 years. They want to know the value of the new strategy. Following information relating to the year which has just ended is available. Income statement is given, and then balance sheet information also is given. Income statement sales is 20,000, gross margin 20%, and then administration, selling and distribution is 20%. So okay, yeah. Then profit before tax, we can see it is 10% of sales. Then tax 30%, PAT 1,400. In balance sheet, fixed assets, current assets, and equity is given. This contributes the total assets. There are no other assets other than these two. If it adopts the new strategy, sales will grow at the rate of 20% per year for 3 years. From 4th year onwards, cash flow will be stabilized. And there is one assumption given: the gross margin ratio, asset turnover ratio, capital structure, and the income tax rate will remain unchanged. And depreciation would be at 10% of net assets at the beginning of the year. This is one type of assumption. And then the target rate of return is 15%, which is the expected return, or KE, whatever we can say. Determine the incremental value due to adoption of the strategy. So what will this business will have an incremental value? That's what we are going to find out. So before that, let us write all the possible changes after the new strategy. First, going to the gross margin ratio, they told it will be same. The gross margin ratio, asset turnover, and then capital structure and income tax rate, this all remain same. Gross margin is 20%. Asset turnover, sales by total assets, 20,000 divided by 12,000, 1.67, that remains same. In capital structure, all equity. In this case, capital structure, only equity is there, no debt raised. So if any new funds are required, that also will be by equity only. Income tax rate is 30%, that also remains same. They told the sales will grow by 20% for 3 years. So first 3 years the sales will grow by 20%, and thereafter same. Then depreciation is 10% of net assets at the beginning of the year they have given. And then target rate of return is 15%. Okay, now going further, since we need to calculate the new strategy adoption, so we are projected for 4 years. As we can see, sales they have given for 3 years, then from 4th year it is been stabilized. So for first 3 years, then 4th year onwards, so this will be onwards. And sales, the base is 20,000, then PBT, as we can see, it is 10% of sales, so 2,000, and minus taxes, and PAT is 1,400. Same way, the growth is for 3 years, so 20%, 20,000 plus 20% is 24, and 24,000 plus 20% is 28,800, plus 20% is 34,560. From then it will be same for the remaining years from then onwards. Then 10% of sale is PBT, then taxes reducing it, profit after tax we got as these values. In the base one it is 1,400, then the first year of projection 1,680, then 2016, 2,419, 2,419. Going to next step, projected balance sheet. Fixed assets and current assets or 40% of the sales. Since they told the asset turnover ratio is remains same, so that signifies to whatever portion, if we increase the sales, the same portion we can increase the total assets also. Let's say in this case 20,000, let's say if we add 20 into 1.2, means 20% is extra. The same denominator also we can do 1.2. Hence that signifies whatever the sales percentage increased, to the same percentage total assets also will increase. And we know that total assets contributes to only fixed assets and current assets. Hence to the percentage of sales we can take fixed assets and current assets. We can't assume this percentage in all the problems. Using this assumption that the assets turnover ratio remains same, we can keep the assumption that the percentage of sales fixed asset to the percentage of sales and fixed asset to the current assets will increase in contrast in the same ratio of increase in sales also. As we can see here, 20% increase, so you can also add 20% to the assets and then increase it. Or simply, since we know that it is 40% of sales, so whatever is the sales we found out here multiplied by the 40% will give us the fixed assets, 20% will give us the current assets. And total assets being 12,000, 14,400, 17,280, 20,736, and then 20,736. In this case, even if we see here, in this case, even if we divide this 24,000 divided by this total assets 14,400 will give us the same ratio 1.67. You can test it out same way for all the years. 28,800 divided by 17,280 will give us 1.67. It will remains the same. Hence that assumption also is carried out. And the next assumption, capital structure remains same, they told. So whatever increase in as we can see here, there is no other capital structure, like there is no other debt or any non-current liability is there. Hence the whatever the total assets will be equal to the liabilities plus capital also. Here only equity is there, so it will be same. So if total asset is 14,400, then equity also will be 14,400. That's what this assumption gives us a hint. Now income tax rate we took the same for all. Then sales percentage also we considered. Now this depreciation we'll check. Okay, now we know the projected balance sheet also is sorted out. Now then we need to calculate the incremental value due to adoption of this strategy. Hence, how will we calculate this incremental value? We have to calculate this free cash flow to firm, then discounting it to the present value terms will give us the value of the strategy. So it's nothing, simply like whatever cash flows this new strategy is going to give in the upcoming years, I will discount it to the present value terms and I will compare it with whatever I'm getting now. In our current case, the PAT is 1,400 and we know the target rate is 15%. So in the current case, it is giving me 9,333. This is the pre-strategy value. Whatever the business is currently giving me, the business value, the current business value. Now I will compare it with whatever the new strategy gives me, right? So in the first year, so for that we need the free cash flow to firm, which will give us the accurate measure of how much operating cash flow is flowing into the business, because operating cash flow helps me in deciding the value of business when we are going for any investment purpose or whatever. So for operating cash flow, which is free cash flow to firm, we have the PAT, and then depreciation they have given the hint that it is 10% of net assets at beginning of the year. And beginning of the year we know base will be the beginning, right? Because this is year 0, base is considered as the year 0, then year 1. So whatever year 0 will be the beginning for year 1. That's what is the assumption. So here 8,000 is the year 0, which is beginning of base 1, multiplied by 10% will give us depreciation for year 1. Then year 2 depreciation is year 2's beginning, nothing but year 1 closing. So 9,600 multiplied by 10, that will give us this. And then for year 3 it is 11,250, 10%. For year 4 it is 13,824. Okay, then we need to reduce the addition to fixed assets and then reduce increase in current assets also, nothing but the working capital changes. In the given case, yeah, there is no current liabilities or anything such. So with the available information we'll be taking only the increase in current asset, which has to be reduced from this PAT to arrive at the free cash flow to firm, and then the capex movement also, which is addition, that has to be reduced. Addition to fixed assets, how will we calculate? Whatever has happened in the balance sheet is after depreciation, right? So the number which we have in the balance sheet added to the depreciation will give me what is the addition during the year. Let's say in the first case the base is 8,000 and in year 1 the closing projection gives us the value of 9600, the difference being 1600. Now this is not the addition, right? Because in balance sheet it will be after depreciation, but addition is what has happened before depreciation, that is the actual value of new furniture or new assets, or new assets bought for the business. So we know the depreciation for the year, adding that will give us the addition. Same way for all years. In the first case it is 1600, which is nothing but 9600 minus 8000 is 1600 plus 800 depreciation. In the second case also 2880, nothing but 11520 minus 9600 will give us 1920, then plus 960 depreciation. Same way for year 3, 13824 minus 11520 will give us 2304 plus 1152. In the third year, since there is no change in fixed assets, we are assuming that the only the depreciation portion is what is addition to fixed assets. This is because let's say this much new assets as purchased, and we have a depreciation of 382, so the addition becomes 0, hence there is no increase in fixed asset from 3 to 4. That's what is the indirect assumption. So only the depreciation portion is equivalent to the addition to fixed assets. Now the next increase in current asset is simple. From the projected balance sheet we will be reducing 4800 minus 4000 will be 800, 5760 minus 4800 960, 6912 minus 5760 is 1152, and there is no increase in the last year current asset. Okay, now using this we found out the operating cash flow 720, 864, 1036, then 2419.2. So these are the cash flows for the 3 years. Then this is not year 4, this is from year 4 onwards. From then it will be fully the terminal cash flow. That's why it will be called as the terminal cash flow, because it is not only for the fourth year. From fourth year onwards, what is the total yield it's going to give me? 2419.2. Okay, now keeping this aside, to calculate the value of this new strategy, we have to discount it into current terms, and the fourth year which we got is the terminal value. So actually we need to find out the terminal value, that is the terminal cash flow, because it's going to continue. How will we calculate the terminal value? 2419 divided by the KE. Actually it will be KE minus G, minus growth rate we have to take. The growth is 0 here because they told it will be consistent, it will be stabilized, and hence the value also will not be added with the growth. So 2419.2 divided by 0.15. In case if they told from fourth year onwards it will be 10% increase, something like that, then what we have to do is 2419 multiplied by 1 plus g, so 10% added divided by 0.15 minus 10 we will be doing. Here we will not be doing that because the cash flow will be stabilized. So 2419 divided by 0.5 will give us 16,128. This will be the terminal cash flow. Okay, now we know for first 3 years cash flows, then terminal cash flow, then we'll be discounting with the respective years. They told the target rate of return is 15%, hence 0.87, 0.756, 0.658 is the present value factors for 3 years. Then terminal value is at the third year only, so third year terminal value will be discounting it at the third year rate, which will give us 8641.76. This is the value of strategy. Now if we compare this with the pre-strategy value, which is simply my PAT divided by the target rate, which gives me value of the business, that is coming up to 9333. So my current business itself is giving me a return of my current business value itself is 9333, but after the new strategy my business value is actually reducing. So we should not be opting for the new strategy. I'm getting a negative value of 691.57, hence the strategy is not financially viable. Thank you.